What if I told you that real estate crashes are predictable? Not the exact day or the month, but the conditions. They're always similar. I've been in this game for over 35 years. I've bought in booms, I've bought in busts, and I can tell you the market is always similar right before it crashes. So let's walk through exactly what happens before a real estate crash. And I'm going to use 3 examples, and then we'll use that to compare with what's going on right now in 2025. Because trust me, there's a lot of noise out there. But once you get to know what to look for, it's pretty clear who's sitting on a time bomb and who is going to get rich from it. So real estate doesn't crash overnight. It builds up over time. The cracks start to form slowly, and then it just breaks. So here are 5 warning signs that I see before every crash. First, prices detach from fundamentals. So what does that mean? Investors stop looking for cash flow and they focus their entire financial model on capital gain or an appreciation method. During this time, people are buying on last year's prices or tomorrow's prices. They're buying on emotion and hype, but not the actual numbers. Everything's based on what the future might deliver. So you hear phrases like, it'll be different this time. And then they start underwriting what happened yesterday or in the past, and they believe that it's going to happen in the future. This is mistake number 1. My rule, buy on fundamentals, never on the future. 2, debt gets too cheap and too easy. Everybody starts to lend and everyone starts to borrow. Interest rates drop and banks start lending just about anyone. So when you start to see 0 down loans, teaser rates, and inflatable debt, keep an eye out because it could be the beginning of a disastrous ending. During this time, operators start buying with floating rate bridge loans that they'll assume that they can refi out of later. When money is cheap, discipline disappears. 3, overbuilding and overconfidence. During this time, developers jump in late and they flood the market with additional supply. Everyone thinks that there's not enough housing until there is. And the problem with development is there's a lag period and it shows up 2-3 years later. Suddenly, your rents are going the wrong direction and vacancies and concessions start to creep in and they mess up all your numbers, especially the ones that you underwrote and gave to your investors in the first place. 4, delinquencies start to creep up. So everyone's fighting for the same tenants. Vacancies rise slowly, rent growth stalls and even goes negative because concessions start to sneak back in. And a concession is simply 1 month free on a 12-month lease, 2 months, 3 months free on a 12-month lease. That literally is a form of a rent discount, but is the precursor to actual rent declines. There are literally properties today that are offering 4 months free on a 12-month lease. That does not cash flow, and there's no possible way that developer or that lender is not absolutely freaked out right now. These are red flags when demand is weakening, long before the prices drop. And the triggering event, which is the 5th thing, that's when rates hike, inflation spike, or economic slowdown tips the very first domino, which we just saw when inflation hit 9.1% in June of 2022, and the Fed started raising rates aggressively to combat it. The reason it didn't hit immediately is because of the lag with the interest rates and the new supply of housing, which is on its way here now, which is why you're seeing the softness. So just like all markets, this system is built on debt that's cheap, that resets, and shaky operators, and then eventually it collapses the deal. And that's when the professionals jump in. Let's ground this with 3 real-world examples. These are not theories. This is actually what happened. The first one that we could talk about that some of you may have been through is the 2008 Great Financial Crisis. So what caused it? Subprime lending, mortgage-backed securities, and adjustable rate mortgages. Cheap money given from lenders to borrowers that had no business getting those loans and couldn't pay them off later. So here's what it looked like. Everyone was flipping houses. There was no doc loans, which basically means that you didn't have to show you had any income coming in, and interest-only loans. So what happened was all that cheap money was given to the public. They all jumped on it, and the price of housing went up as a result of the cheap money, not as a result of the market or the people. It was a result of the cheap money. So when the rates adjusted and the values dropped, which they always will, the people walked away from these homes that they never should have owned in the first place. It didn't matter if they were buying the home to move in, or they're buying home to flip it, or to rent it long term. When rates adjusted, it killed everything. So the takeaway is, of course, cash flow didn't matter to anyone, and that's exactly why it collapsed. The second one, which I remember, which many of you might not, is the Japan real estate bubble. Very different scenario, but worth mentioning. Well, so what caused it was loose central bank policy, stocks, and land speculation. And here's what it looked like. Land in Tokyo, if you can believe this, was valued higher than all of California at the time. That's no joke. The result, the government started tightening the credit and the prices collapsed. So it started with the government's central bank loose policies, and then the government tightened it back again, and then prices collapsed. Guess what? It took over 30 years for this to recover. The takeaway, exact same thing during the US Great Financial Crisis. Buy on cash flow, not on speculation or appreciation. The exact same issue, different country. Be careful when anything is fueled by easy credit and leverage, and especially national hype.
Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
The third one was the Spain real estate crisis. Now, this happened not very long ago, so many of you may have been paying attention to this, or maybe not. What caused it? Overbuilding, fueled by what? Cheap credit, once again. So Spain was building over 800,000 homes a year. That's more than France, the UK, and Germany combined. So here's what it looked like after a while. Coastal resorts and empty apartment blocks and houses in ghost cities and ghost towns all over the place. This is not that much different from what we're seeing with China right now. The result, of course, once again, all based on speculation, and the supply massively outpaced the demand. So in other words, there wasn't the population or the demand of the people buy or rent or occupy whatever had been built, because the entire bubble started from cheap credit, just like in Japan, just like in the GFC. Afterwards, very predictably, unemployment soared and banks collapsed. Sound familiar? So the takeaway, when you're surrounded by cranes, you're probably late to the game. By the way, this can happen in cities, it can happen in countries. So as you start to look around in different areas to invest in, like about a year ago, I went to Nashville and there were about a dozen cranes in the air. It's a very small market. I'm like, this town is done. So now let's compare it to 2025, and where are we now? Let's bring it to today. Are we headed for a crash in 2025? Well, here's what I see. Prices are high, even in normal markets, and affordability is severely stretched. People are renting instead of buying, and some people are paying 200 to 300 times the monthly rent just to buy. So in other words, there's a massive repricing that needs to happen, and people are being forced into rentals right now, which would be good for landlords, not necessarily good for the single family market. 2, interest rates are still elevated. Now, I know there's a lot of chatter around Trump and Powell and their argument over lower rates, but it's not happening anytime soon. So a lot of these folks bought deals in 21 and 22 at 2 and 3% rates, and the country is kind of locked. They have frozen equity in a lot of places. And those that have adjusted, the new rates are 6 or 7%. The floating debt, that's crushing everybody. It's crushing cash flow. And those people can't afford to hold on to those properties, because who can afford when mortgage rates almost double? So what President Trump's trying to get ahead of is lowering these rates so these people don't lose those assets and create a real estate crash. At the end of the day, he is a real estate investor and developer and understands how important interest rates are, especially when they were low, then they went high. He's trying to get interest rates back to what they were not very long ago. Third thing that's crushing people right now are the rising interest costs and property tax costs, especially in states like Texas and Florida. This is a silent killer. So many of you may know about this already. It's almost impossible to get insurance in some of those areas. And in the condominium projects, we're starting to see massive declines in that particular sector in those areas. So I've seen deals that are cash flowing just a year ago that have gone immediately negative just from insurance hikes and now property tax hikes. So in many areas, we're starting to see delinquencies as a result of these things. We're seeing multifamily defaults, especially among syndicators that were buying in 21 and 22 based on market appreciation, based on capital gains. And those interest rates have reset. Now they also have these higher expenses. Office, as we all know, has already crashed and is starting to stabilize a little bit. And we're starting to see redevelop in the smaller office spaces. But the big ones, they're still in trouble. Retail is a little bit shaky, but it's also actually stabilizing a little bit depending on what market you're in. And I'm even seeing that in many areas, self-storage is also suffering because largely self-storage is typically based on single-family development. Now, if you think about it, as the neighborhoods expand, they typically need more storage in those areas. So when that contracts back, you start to see a softening in self-storage. But one thing is for sure, we're definitely seeing inventory climb in certain markets, and this becomes the opportunity. So new supply is still coming online from construction that started in 21 and 22, but those interest rates have reset. And so those developers, those syndicators are now in trouble because they've been funding these deals ever since the rates went up. Meanwhile, demand is starting to slow in these overheated markets. Is it 2008 again? No. But there is a reckoning happening, and it's happening silently. Those who are paying attention are going to capitalize on this opportunity. The people that are going to get crushed, the people that did not buy on cash flow. They bought on hype, they bought on emotion, and they bought on a capital gain strategy. It is not working out today. So the question is, what do you do with all this information? Number one, buy for cash flow, not appreciation. Hopefully, I've made this clear to you. If the deal does not cash flow today, do not buy it. Appreciation, capital gain, always a bonus, never the strategy. 2, use fixed rate debt. I cannot stress this enough. Fixed rate debt saved us in 2008, and it continues to save us. You always want to know what your mortgage payment is in the future, because that is something you can control on the day that you buy. Do not gamble on rate drops. Plan for what it is today, not what it might be. Stress test your deals. Ask yourself, if rents drop 5% and expenses go up 10%, do I still survive? Do I have the capital reserves to survive? And have I budgeted properly? What happens with most people is they budget big rent growth moving forward in unstable times. And this is simply just inexperience. If the answer is no, you're not investing, you're speculating using other people's money. 4, stick to strong markets. I cannot emphasize this enough. Real estate does really, really well where people move. That's it. Real estate needs people. So if you're buying in a market where there's not very many people or the edge of town or people are moving away, should not be a surprise to you that it's hard to rent. So make sure that you're buying in strong markets. Look for population growth, job growth, and supply constraints, also very important. Not all real estate is created equal, and location still matters and should be the primary reason that you buy. The real deals, the distressed stuff, they're already coming. I just met with somebody over the weekend that had 5 deals in trouble that I'm starting to look at today. So every real estate crash is a little bit different, but the warning signs, they are always the same. Cheap debt given to people that can't pay it back. Overbuilding, which is always a lag and hits a couple years later. Emotional buying and underwriting based on the past. And finally, the reality sets in. It's always the same. The investors who stay grounded, who buy on the numbers, they use fixed rate debt and focus on cash flow, they're always going to win. Everyone else, they're going to learn the hard way. Hopefully, they become a little wiser and adjust their strategy moving forward. So you want to see what I'm buying in today's markets, even with high rates that definitely cash flow? Check the video on the screen, and I'll walk you through a real deal that we just bought.